This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So this week we covered off a lot of material, some good current topics we covered out quickly, and then a couple of really good in-depth discussions, one around gold, which is actually pretty fascinating, and the other one around tax loss selling, which I think we get technical and we ran perhaps a little long, but there were some great takeaways in that.
Yeah, I find tax loss selling to be an interesting topic. We didn't talk about this during the episode, but that one came from someone recently who emailed me saying they've been following Canadian Couch Potato and Justin's Canadian Portfolio Manager blog, and they're doing their own ETF thing, but they've been getting to the point where they've got some losses and they're thinking about loss selling. But as they're doing the research on superficial losses and stuff like that, they're starting to wonder, like, is it worthwhile? Is there actually some risk here? And I thought that question was great because I started and never finished a paper on that exact question. So I went and dug that data up and we talked about it on the show today.
So it was actually a much more interesting conversation than I thought it was going to be when we prepared for this.
You always think my topics are going to be boring. I
never think they're boring. Sometimes I wonder if we go too long, but this one, it was long, but it's important. And while some people, it may not matter to them, for those that do, I think you'll get a lot out of the discussion. And then we got, of course, the bad advice of the week, which I'm sure a lot of our listeners, if they already know about the story, they kind of know where we're going with it, the Toronto Star article.
Yeah. So anyway, we always appreciate people going to the rationalreminder.ca website and leaving a comment, and we hope you enjoy the episode. Welcome to episode 62 of the Rational Reminder Podcast. We chose to do 3 current topics today just because the 2 of them were interesting, but there's actually not a whole lot to say about them.
We can burn through them pretty quick because the other topics are pretty meaty.
Yeah. So the first one we wanted to chat about was that Horizons, which we talked about. Well, we had Jamie Purvis from Horizons on the podcast to talk about the swap-based ETF structure. And we've talked about the structure in the past. And we know that in the most recent budget, the Redeemers methodology, which the swap-based ETFs had been using to recharacterize income so that unit holders wouldn't have any distributions. They would just have unrealized capital gains over the long term, which is obviously very tax efficient. The government's targeted the methodology they were using to do that.
So that change is inevitable, right? Or it's thought to be inevitable?
It sounds like they've deferred part of it. So as I understand, there were 2 pieces. There was the income allocation and the capital allocation. And I think that the capital, they're giving another year to defer because that's the one that was going to affect administration for ETFs and mutual funds. So they're going to continue considering that. But the income portion, which is the recharacterization piece that the government was losing a bunch of money on, that's the piece that it sounds like is going through.
So Horizons is looking to protect their business, of course.
So I talked to Jamie about it. And he said that they had been thinking about doing this change anyway. So they're restructuring all of the ETFs that use a swap-based structure, and they're rolling them into a corporate class structure.
Which I think a lot of people will be familiar with. I mean, it's made popular by CI and other firms.
That's right, yeah. All of the different fund types are different share classes within a single corporation. So all of the units are within one corporation. Now that used to be interesting because you could switch between classes of the corporation without triggering a disposition.
And that was always the pitch.
But that's dead now.
Yep.
That's gone. And there were other issues with that in terms of who capital gains would ultimately be allocated to. Like it could end up being tax inefficient for some people. But anyway, that's gone now.
So what's the benefit to Horizons making this switch?
So the benefit is instead of having to rely on the Redeemers methodology, which is under this hot fire at the moment, they can just net out gains with losses inside of the overall corporate structure. And they can also net out fees from the total income of the fund. Now, the downside with the corporate class structure is that if you do have net income in the corporation, unlike with the trust, you can't just allocate it out to be taxed in the hands of the unit holders. With the corporation, if there is a net income position, the corporation has to pay tax at the corporate tax rate. So that can hurt if there is a net income. But because they have all of these different products under one corporate roof, we wouldn't necessarily expect a net positive return across all of their products in most years, especially because they have so many specialty products.
But you cannot switch between ETFs like the old corporate class structure and not pay capital gains because these are ETFs, right? You have your own cost base.
Well, even with corporations, you can't do that now. That's dead.
Right. That's what I mean. So there's no going back to the way it used to be with an ETF. You have your own cost base. You sell, you trigger your gain or loss. You get your own cost base on the buy side.
The big benefit is that potentially by pooling all of the gains, losses, and fees, you may not have any distributions from the fund, just like it is now. So that Horizons believes that the funds are going to be just as tax efficient with the new structure as they were with the old structure. The other piece that's interesting is that they're able to roll all of the trust assets that are currently the existing ETFs into the new corporation using a Section 85 rollover, which is a non-taxable disposition where you move assets from personally or held in a trust, I guess, into a corporation.
Cool. Well, you got to give it to Horizons. They're always in the weeds on this kind of stuff.
Are they ever?
Yeah, and Jamie is very articulate on this. On to topic number 2. It's an article we saw in Bloomberg, I guess it was this week. Michal Burry, who was made famous in the movie The Big Short, who made the call on what the CDOs, collateralized debt obligations, back in 2008.
And this fund's not that big.
340 million or so?
343 million.
So you wonder about conflict of interest, but he's basically saying that index funds are creating a bubble in the large stocks.
And we've heard this before. The reason that I grabbed this one, I thought it was interesting. Like the idea that index funds are creating a bubble, I don't know how much credibility that has to it. But in this article, Burry was basically saying that he blames this phenomenon for the underperformance of small cap and value stocks.
Was he arguing there's not as much price discovery going on there? Or is it just the demand side for large cap growth stocks is pulling everything up?
I think that the understanding here would be that because of blind money going into index funds, the larger stocks are getting bid up irrationally.
Yeah, but there's still price discovery going on. And there's still trading going on with the small cap value shares. So does that...
I agree with you. And that's why I said I wouldn't usually grab a headline like this. But just the way that they went into this potentially being the reason for small cap and value underperformance. Maybe it's me just grasping at explanations.
You saw the movie The Big Short?
Yeah.
Christian Bale was great.
Yeah, it was great.
If you haven't seen the movie, you have to watch it. It's a phenomenal movie. Michael Lewis is such a great storyteller.
But it is crazy when you look at the IPOs that are coming out and that have come out, and you look at the mega cap tech companies that are doing so well, and their PEs are so high. It is unnerving. We believe markets are efficient. We believe in rational pricing. But I mean...
Well, look at what Ted said last week in the podcast. All this competition and the rise of index funds is basically flushing out all the weakest active managers, which is arguably making it tougher because you're left with the best fighting over this price discovery.
That's Fama French's whole thing on when does the market become inefficient due to indexing. And they say, well, it depends who leaves active management. If the only ones left are the good active managers and the bad active managers get booted out, that might actually make markets more efficient. So it's a tricky argument to make.
Because if you're the good ones, you'll command the premium, which Ted also talked about last week. And your premium theoretically should equal the alpha you deliver. So it should just theoretically go away.
Yeah. But then we also just had people listening to the podcast won't have heard this yet. But in episode 69 coming up, we have Wes Gray from Alpha Architect. His firm and him personally take the stance that a lot of the factor premiums are behavioral. And so from that view, maybe that is what's going on. Maybe the large cap stocks are getting overpriced and that they're going to come down in valuation eventually. And maybe the value stocks are being underpriced. And then the argument would be that eventually people are going to realize the value stocks aren't as crappy as we thought they were and the prices are going to come back. Anyway, who knows is the ultimate answer.
So that's your little tease looking out, whatever it is, 7 weeks from now or something.
Yeah.
Okay.
Oh, that was a fantastic conversation. But anyway.
Number 3 topic. So we'll go through this one quickly. So another article came out from Morningstar that resurrected an old paper, and this is pretty cool. So it's called Canadian Financial Advice, Good Intentions but Bad Results. And can you believe they had access from 2 large Canadian financial institutions, which they've sworn to secrecy, of course, looking at the performance from trading for 3,276 advisors and over 500,000 clients.
I don't know if we've talked about this in the podcast before. I did a video on this specific paper a while ago, but the interesting part was Rekenthaler from Morningstar. I guess he just discovered the paper. He wrote about it, and it basically shows that advisors are making really bad investment recommendations, not because they're jerks, but because they have no idea what they're doing. And the way they proved that, or tried to prove that, was that all of the bad investment recommendations that the advisors were making to their clients, they were also doing in their own trading accounts.
And actually paying more themselves than their average client.
In fees, that's right.
In fees, the MER. So the average MER for all these clients was 2.36%, and the advisor's fees were 2.43%.
Yeah.
But what I found surprising is the performance was much better than I would have expected. Basically, the underperformance is almost completely explained by the fees. I would expect a much larger behavior gap to happen. The quote is, they weren't greatly harmed by their investment errors. What really hurt them were their expenses.
But Rekenthaler's reason for writing this is that the U.S., like Canada, the U.S. has had all these talks about a fiduciary standard or a best interest standard. And this is the same thing that we concluded when we read this paper a couple of years ago. But Rekenthaler is basically saying he no longer believes that the fiduciary standard is the answer. Because even if advisors think they're acting in the best interest of the client, if they have no idea what they're doing, then nobody's going to be any better off.
So how did they draw that inference from it, though? Because it says that they only underperformed based on fees. Where does it leap that they were...
misinformed?
Yeah, misinformed.
Well, the basis of them being misinformed is that they're investing their own money in high-fee, actively managed mutual funds, and they're over-trading and they're performance-chasing, like all these bad behaviors. I agree it's interesting that doesn't show up in the performance gap, but the point is, it's not like the advisors are investing in, Vanguard ETFs while churning active mutual funds for their clients. They're investing in the same garbage. But Rekenthaler, the last line of his paper I thought was really good. He said, what I now understand is that most of those gains to benefit investors will come from within the marketplace by advisors continuing to learn from history, and one hopes by stronger educational programs from both their employers and the fund companies that solicit their business. Regulation can and should do its part, but advisors' personal beliefs will lead to change. And that's actually, Freakonomics did a whole thing a while ago on the medical field, and I don't think they drew inferences to investments. I think I did that in a blog post, I think. But Freakonomics talked about the whole shift from medicine being opinion-based to being evidence-based. And they talk about how it took a whole generation of opinion-based doctors who operated that way to literally die off so that that evidence-based generation could take over.
Wow.
And you got to think it's going to be something similar in financial services, where there are so many people with such strong opinions and such strong client bases and sales forces that base everything on opinion and anecdote. And it's such a small subset of us that are trying to be evidence-based. Yeah. So it'll be tough to change everybody's mind without a whole generational shift, I think. What do you think?
I totally agree. I mean, that's the whole point behind the rational reminder.
Yeah, that's right. And it is awesome that we know a ton of advisors are listening to this podcast. So hopefully that's helping turn those tides of change.
Okay, so portfolio topic this week's a pretty meaty one that I know you've had some fun preparing for. It's all about gold.
Yeah, but gold always comes up when, we've joked about the recession in the past. And by the way, I don't think recessions are funny. I just think that it's funny that people think they can predict them.
And when it comes up in every single meeting, you know it's got to be priced in somewhere.
It's everywhere, though. If you go on Reddit, I know you don't go on Reddit as much as I do, but it's like every third post is, what should I be doing to prepare for the recession? What changes should I make in preparation for the recession? It's like, man.
Here's a thought. Build a portfolio so you don't have to worry about it.
Right. Have sufficient.
Because the market can go down even if there isn't a recession.
Have enough emergency savings that you don't need to worry about your portfolio even if
stuff happens. Embrace variability. Anyways, gold.
It's like anti-fragility almost.
Totally.
I told you last time I've been listening to this book, Coddling the American Mind. They talk about a lot about anti-fragility.
So have you had people actually ask you about gold lately? Because I have not.
Not this time around. People are talking about it online, and the headlines are talking about it, and the price, the gold price, shows us that people are interested in it because the price has had a bit of a bull run. Yeah, but not this time around. I think in past little market dips and things like that, I've had more questions about gold. For whatever reason, it's not coming up as much this time. But I figured it was still worth discussing because just based on the price, there's clearly some interest priced into the asset.
Yeah, and Buffett had the classic explanation of gold.
Yeah.
And then we used it on a radio show a long time ago when he came out with this. So go ahead, tell the story.
Well, Buffett says that gold's not a productive asset. So he did this example, and we'll talk more about the data in a sec, but this is just a good story from Buffett. So he gave the example that at the time that he wrote this thing in 2012, the world's gold stock was worth about 9.6 trillion US dollars. And he explains that for that amount of money, at that time, you could have bought all of the cropland in America, in the US, 400 million acres with roughly $200 billion of annual output. And you could have bought 16 Exxon Mobils, each one earning 40 billion annually. And then he says after that, you'd still have $1 trillion US dollars in cash left over. And I can't remember what he said in the story, but something along the lines of, you may as well keep some spending cash after a spending spree like this.
And didn't you say if you put all the gold in one pile, it'd be the size of a Major League Baseball infield?
That's right,
a cube. It'd be about your height with that cube.
Yeah.
And it's basically just a dead asset that you now have to pay to take care of and custody and guard.
Yeah. So then Buffett goes on to say that a century from now, the 400 million acres of farmland will have produced a massive amount of output, regardless of the currency regime at the time, which I find to be a pretty interesting component of what he's talking about, because that's kind of like rebutting against gold as a currency hedge if you buy productive assets. And then he also says that Exxon will have produced obviously trillions of dollars in profits. Well, maybe not, depending on what happens with climate change and stuff. But anyway, trillions of dollars in profits for shareholders, and they will have also grown their assets to be worth many more trillions. And then Buffett says that gold will have just continued to be a chunk of gold, which, like you said, Cameron, you would have had to pay to care for and store and insure and all that stuff.
So these are great stories, but of course, as everyone knows...
Well, I got to say, this line from this story was too funny. He says, you can fondle the gold, but it will not respond. So anyway,
so you're going to take the data trip now.
Yeah. So people think about gold as a currency hedge. They think about it as a safe haven from stocks. I agree with Buffett's analogy. I think it makes sense, but let's see what the data say. So there's an academic paper by Claude Urban Campbell Harvey. This is also in 2012, actually. And they used gold returns going back to 1975 for a lot of the analysis. They went back further for some, but that was when the U.S. came off the gold standard.
Exactly.
So the price of gold was heavily affected by, I guess, the U.S. government policy up until that point. So they found that gold has not been a good inflation hedge over the short or long term. Long term, they were saying, is 10 years due to the volatility of gold's real price. And we'll come back to that because that's one of the most interesting components of this discussion. But they did find that going back to the era of Emperor Augustus, who reigned from 27 BC to 14 AD, gold has been a pretty good hedge for inflation measured by military pay. So 2,000 year in the future liability, maybe gold is a good inflation hedge, but over shorter periods of time, it's too volatile. So they finished that section of their paper saying gold may very well be a long-run inflation hedge, and I love this. However, the long run may be longer than an investor's investment time horizon or lifespan. It's like, sure, gold's a good inflation hedge over the very long term, but you're probably not going to live long enough for it to be a good inflation hedge for you.
I find gold is such a great story for a lot of people.
Yeah.
Kind of quasi-conspiracy theory type people. There's always a story around it.
Yeah, there has to be.
Has to be.
That's by definition why people will buy gold, because they believe the story around it enough to believe that someone else will buy it from them for more later. That is how gold is a store of value.
Yeah, I think I mentioned someone I know in the past has said, we're all going to, where I just want to get there last.
Huh.
And so that was his reason for wanting to own some gold. And I'm like, okay, if we do go to that awful place, how are you going to watch over your gold? How are you going to slice off your gold to buy your groceries at the store? Like, I don't quite get if we do end up in that catastrophic situation.
Yep. So Urban Harvey also looked at hyperinflation. And I found this, of the whole paper, for me, this was the most interesting piece. So they looked at Brazil from 1980 to 2000, where Brazil had massive hyperinflation. Their currency inflated at about 250% per year, while the real price of gold in Brazilian terms fell by about 70%. So the interesting part about it is that the real price of gold in US dollar terms fell roughly the same over the same time period. And Kelman and Harvey looked at this throughout the paper, and they found that the real price of gold in any country around the world tends to be roughly the same at a given point in time. So real price changes in gold are going to be roughly the same whatever country you're in. So they found that to be true throughout history. So the interesting thing about being in a hyperinflation hedge, and using Brazil as the example, is that yes, over that time period, holding gold was better than holding whatever the Brazilian currency was. And it's not that I don't know what it was, it's that they changed it a bunch of times throughout that time period. Not that I could name any of them, to be fair. But yes, gold would have been better because it only lost 70% of its value as opposed to almost 100% holding Brazilian currency. But the point is that the real price of gold can have a dramatic drop at the time that whatever country you're in is experiencing hyperinflation. So it's not like you can hold gold and expect it to maintain its purchasing power just because your country is going through hyperinflation. It could very well happen that your currency is hyperinflating while the real price of gold is also dropping dramatically. So that makes it not a good hedge.
Interesting.
It is fascinating, right?
Mm-hmm.
So it's like, sure, you can hold gold and maybe it won't lose its real value, but maybe it will. And there's no reason to believe that it won't. Gold doesn't care that Canada's going through hyperinflation. Gold's not going to say, oh, time to go to the rescue and increase my real value or maintain my real value. It could happen for some other reason. Gold's real value is plummeting while Canada's dollar is also hyperinflating. So I found that to be pretty interesting.
Now, what about when you hold gold in a portfolio? I know you've got some numbers on that.
Yeah, so
a lot of people would say, look, I'll just hold 5 or 10%. It's a reasonable hedge, may have some benefit.
So Urban Harvey looked at this in their paper too, and they did find that 83% of the time that stock returns were negative in their data set, gold returns were positive. So that's interesting. So I looked at the gold spot price. I had MSCI All Country World Index going back to 1988 through to July 2019. So I used that as a sample. And the gold spot price and the All Country World Index had a correlation of 0.085, which is very, very low.
Wow.
So it's basically an uncorrelated asset.
Yep.
Not negatively correlated though. So we don't necessarily expect gold to go up when stocks go down. We just expect them to be uncorrelated.
And what are the return differences between the two?
Well, yeah, so I've got those data points too.
Okay.
I found it interesting though that in the calendar year 2008, when the All Country World Index dropped by over 40% in US dollar terms, gold increased by 5.53%. So that seems pretty interesting. But over the same time period, US government bonds increased in value by 14%.
Wow.
So it's like, yeah, gold was maybe a good diversifying asset, but bonds were better. So the real issue that I have using gold as a diversifying asset, even though it's got the low correlation, is that it doesn't have an expected return.
And that's Buffett's point.
That's Buffett's points. That's Dimensional's written about this as well. It's like, yes, sure, it's uncorrelated, but based on modern portfolio theory, you want to have assets that have positive expected returns in your portfolio.
And the only reason to own gold, therefore, is because there's a story. You're predicting what might happen, and you believe how gold prices may react if and when that happens.
Now, this data point here it's arguably unfair because it's a period of time where gold happened to not do well, and there have been periods of time where it has done well,
right.
But it is still interesting. So for the same data sample from 1988 through July 2019, the standard deviation of gold spot price was 15.43% compared to 14.85% for the global index.
So just a bit more volatile over those 30 plus years.
But its returns for gold were 3.43% before inflation, while global stocks returned 7.85%. So you've got more volatility in gold for a much lower return. Now, again, that's time period specific. There have been periods where it's been different. So then I thought, okay, what does it look like if I add gold to the equity index because it's uncorrelated?
Yeah, because the first example is owning only gold or
Correct.
only the MSCI World Index.
Correct.
So now you're just looking about adding a bit into a portfolio.
That's right. So I took global stocks, 90%, 10% gold, spot price. And it actually did give, and you'd expect this based on the low correlation, that the portfolio had a lower total return, but it had a slightly higher risk-adjusted return. So, okay, that's interesting. But then I said, well, what if we added an asset that actually has a positive expected return and a low or negative correlation with stocks?
Such as?
So I did 1 to 5 year global government bonds hedged to Canadian dollars and added 10% of that to my 90% equity portfolio. And that portfolio had higher total return and a higher risk-adjusted return than the 10% allocation to gold. Now, again, time period specific, but we would expect that to be true long-term because gold does not have a positive expected return. And then Urban Harvey in their paper, you already mentioned this, Cameron, but you can make the argument gold's a safe haven based on its low correlation, even if its real value might plummet, which we've talked about. But you can't really take your gold with you in a real catastrophe. So it's like, what does a safe haven mean? Is it a low correlation with stocks? Okay, sure. But bonds are probably better for that purpose. And if gold is designed to be like the ultimate safe haven in real catastrophe, then are you going to take it with you? Urban Harvey gave an example. I can't remember what it was. I should have written it down, but it was a ancient city that was sacked and the people that sacked the city took the gold.
Anyways, cue the trolls on our comment section. I'm sure gold bugs will come out.
Maybe. I think that we'd probably take more heat for talking about Bitcoin today, but who knows?
Okay, on to our planning topic. So this one comes up a lot in our world, which is tax loss selling, and it's something that's often promoted by robo-advisors as a great value add. So this is where if you have a loss in one of your securities in your portfolio, you can trigger the loss and use it against gains that year or pull it forward indefinitely. Or if we've done in many cases, you can take that loss and go back 3 tax years to prior years.
I think that's the most compelling case. If you have a gain in the last 3 years and you can basically undo the tax that you had to pay by triggering a loss in the current year.
We've done a lot of that. People have triggered gains and you go back, it's money in your pocket, right? Just from doing a switch. Now you have to be careful what you switch in and out of, but it's a great strategy to be aware of. And it just shows the value of knowing enough about your tax returns and the source of your income if you do have prior capital gains.
Yeah, you talked about robo-advisors using this as part of their pitch. I'm pretty sure Betterment in the States have been saying this for years, and I think Wealthsimple now for their higher tier offerings is also saying you can choose to turn loss harvesting on or off. Now, the challenge that I have with that is that if I'm Wealthsimple and I've got automatic tax loss harvesting going on inside the account, they're not, as far as I know, like you just talked about, Cameron, looking at the tax return and figuring out, is this an optimal thing to do in this year? And the reason that it's not necessarily a guaranteed benefit is that there's this rule called superficial losses. So if you sell a security at a loss, you can't own that security for 30 days after selling it if you want to use the loss to offset gains. If you own the same security within 30 days, the loss will be deemed superficial, which means it will be denied by CRA for tax purposes.
And you have to be careful of that.
Well, it's tremendously important, obviously. And for index investors, it means buying an index fund tracking a different index.
So different supplier is not necessarily good enough.
It's absolutely not good enough.
But a lot of people think it is. Different supplier, different ticker symbol. But no, it should be a different property.
Right. Yeah.
Same goes for making contributions. If you make an in-kind contribution to your registered account, that capital loss is denied. So make sure you...
So they can't be identical properties. And that, like you said, if you're fund tracking the same index, but from a different company, that is a superficial loss. So you have to find a tax loss selling pair, which is an asset that's going to give you a similar exposure in the portfolio, because obviously you don't want to sell the asset and sit on cash, because then you're potentially losing out on any benefit of a loss sale. So you want to replace, say it's a Canadian equity ETF that you've sold, you want to replace it with another Canadian ETF, or Canadian equity ETF that's tracking a different index.
And there's so many available, there's really not an issue there.
There's not an issue in doing the replacement. The issue comes in the tracking error.
Yep.
By definition, you're not going to get the same returns from 2 different indexes. Because we talked about in the podcast a while ago, indexes can have pretty different methodologies in terms of how they're weighting securities, how they're selecting securities for the index.
But if you're talking a month, you can go back to the original.
People always say that, but we've done this. We've done this in practice, Cameron, where we do a tax loss sale, hope to get back into the security that we wanted to be in, and then 30 days later, you're in a big gain position.
Well, that happened. We did this in December last year. Then you try to switch back in January. The market popped up so much, we didn't want to trigger the gains again.
Right.
So you can get landlocked for sure.
That's right. And it's like, crap, we just did this great loss sale and we saved some tax, but now we have this new gain and we can't get back into the security that we wanted to have exposure to. So I looked at this for a couple different securities just to get a feel for what do the numbers look like. I looked at VCN, so that's Vanguard FTSE Canada All Cap. and XIC, which is S&P TSX Cap Composite from iShares. And I had data going back to 2013, which is when VCN started. And I looked through March 2019. I looked at this a while ago. And the performance difference annualized was 55 basis points. So it's like, that's material. 55 basis points is it's not an immaterial amount. I also looked at XUU. So that's tracking S&P Total Market Index from iShares versus VUN, which is tracking the CRSP US Total Market Index from Vanguard. And September 2013 through March 2019, they had a 17 basis point tracking error. So again, not huge, but non-zero, especially when we're talking about index fund world.
And just a reminder, you can only use capital losses to offset capital gains.
Great point.
You can't use it to offset regular income.
Very important reminder.
So there's no point in banking losses just for the sake of banking losses.
Correct. I also looked at index returns going back further. So I looked at, again, CRSP US Total Market and the S&P US Total Market Index, but this went back 2005 because it was index data as opposed to live fund data. And again, 18 basis point tracking error. Now, the big risk is that tracking error is an unpriced risk. You wouldn't expect a positive return for buying a CRSP index versus a S&P index. So you're taking on this random risk for doing the tax loss sale. And that gets even more extreme. Like for us using dimensional, the tracking error is going to be way higher because you can't buy an ETF to replace the exposure. But even if you're using small cap or value ETFs, the definition of value and even small can be vastly different between different ETF providers.
Exactly. And often the ETFs, they don't have the small cap growth exclusion, so it will not be the same index.
So the thing that I wanted to look at is how much value would you be adding if you made the perfect tax loss sale? So I looked at a $100,000 investment position and I assumed an average annual return of 5%, all unrealized capital gains. And I assume this investment drops 50% in the first year.
So this is the single investment.
Just one piece of the portfolio. So $100,000 investment now drops to $50,000. So now we've got a $100,000 cost base and a $50,000 market value. If we do a loss sale and assume that we have a gain in a previous year to offset, we'll get a tax savings or a tax refund of $13,383.
So you're pulling that $50,000 loss back to a prior year's capital gain, refiling that tax return, and triggering a refund.
Correct. And then just to model the example, I assumed that $13,383 in tax savings is reinvested in the position. So now in our loss sale case, we have $63,382 invested. And the cost base, because we've sold and rebought a different security.
So you took the tax refund, the $13,000, added it back to the $50,000 portfolio.
Right.
Now you have $63,000.
Invested in a non-identical property tracking a similar market.
So I think our listeners can tell, and I'm trying to make sure we're keeping this straight because it's hard to do numbers over a podcast.
I think you're doing a good job. It's not like this is the first time we've talked technical on the podcast.
I think they're on to our recipe.
Yeah, I think you're right. So that's case one. Case two, what if we didn't trigger the loss? Now we've got $50,000 invested with a higher adjusted cost base of $100,000. So I think that's one of the most important things to understand about the loss sale is that it's a tax deferral. You're not making taxes disappear. You're deferring taxes into the future, and that shows up as a lower adjusted cost base.
So $63,000 cost base portfolio versus a $50,000 portfolio with a cost base of $100,000.
That is correct. So then I went forward 30 years and just did the future value of each portfolio at 5% and sold the assets and paid the capital gains tax to find what is the difference in annualized growth after tax between these two cases.
So basically that $50,000 portfolio, the next 50 it makes is tax-free because the cost base is so much higher. Effectively, that's what's going on. Whereas the $63,000, everything you grow from here is taxable. That's the big difference.
Correct. So, and the whole point of me doing this number crunching is to figure out the value add in basis point terms. Now, this is time period specific, so we're looking at a 30-year time period. If we change the time period, if we go longer, the annualized difference decreases because the value of the value of the deferral relative to the overall portfolio becomes smaller.
The proportion of that $50,000 tax-free becomes a smaller proportion of the total gain.
Correct. And then the other big piece of this is what is your tax rate when you eventually trigger the gain? If you do the loss sale at a 20% tax rate and then ultimately sell at a 55% tax rate, you might actually be worse off.
Okay, suspense is killing us.
Okay, so 53.53% tax rate at the time of deferral and then future tax rate of 20%. So this is the perfect loss selling case.
Yep.
I found a tax alpha, I named it, a additional risk-adjusted return from a higher after-tax return. It added 74 basis points of value on that position, not on the whole portfolio, on that one position, which is meaningful. It is meaningful, even relative to that tracking area of 55 basis points for those two Canadian ETFs that we looked at.
So that's because you have an extra $13,000 kicked into the portfolio that's compounding over those years. That's what's going on here.
Yep.
It's the value of that extra tax money you're getting back that's compounding over that amount of time. That's what's driving this, as opposed to the value of the next 50,000 being tax-free.
It's all to the spread in tax rates, right?
But it's the same of both scenarios, though.
You're right.
So it's the value of getting your money back from the government that's adding the value.
But the spread also changes if you change the future tax rate.
Fascinating.
The advantage changes if you lower the future tax rate.
So the future tax rate is higher. The advantage is
less. If the future tax rate is lower, like we used in our example, the 20% in the future, the advantage is greater.
For sure. That makes sense. Wow, that's really interesting.
Yeah, well, I guess because that chunk of tax savings that we got to invest, the 13,383, the lower your tax rate was at that time, the smaller that number is going to be.
But behaviorally, the big takeaway here is if you did do this, make sure you kick that refund back in the kitty.
Well, from an economic perspective, if you have that cash, it's the same deal. In terms of the actual, like tracking this example, you're right.
I know, but behaviorally, you might be better off leaving that unrealized gain in there if someone's just going to blow it on something.
Oh, wow. Interesting.
Right? Say, yes, you come out mathematically ahead in this perfect sanitized world that you've described. But if someone's not inclined to kick it back in, that unrealized free gain that's coming up going forward is like a forced savings plan.
Yeah, that's interesting. So then I looked at what if the future tax rate was 53.53% if it stayed the same, and the value added from the deferral drops to 57 basis points.
But still big.
Still big.
That's amazing.
Now, I also thought about what if the capital gains rate, inclusion rate, increases in the future, and the value then drops even further because you hear the government sometimes talking about increasing capital gains inclusion to 75%. The only cases where you would expect it to detract value is if you're doing a loss sale on a low tax bracket. So that comes back to the idea of Wealthsimple or whatever, doing loss selling for people blindly just because the person checks the box, yes, I want loss selling. If that person has a taxable account, but they've got a low tax rate, like maybe they're earning 75K, but they just have some taxable investments. If they're deferring tax at a low rate and they end up for whatever reason being at a higher tax rate in the future, maybe they're making large RSP withdrawals or whatever, it could make you worse off potentially, which is why understanding that each individual situation, if you're going to be doing loss sales, is so important. And then the other crazy piece about this, and this is kind of the last thing I thought about as I was thinking about this problem, is that if your horizon's too long, I pushed it out to 100 years just when I was doing the analysis to see what it would look like. And at 100 years, the difference is 25 basis points. So that seems to kind of be where it converges. That's the maximum value of the deferral over a very long period of time. So you can't be doing this for too long of a period of time, but you also have to do it at a period of time where your current tax rate is higher than your future tax rate. But you can't be doing it for a sale too far in the future. Well, I mean, you can, but the benefit's not going to be as great. So it's like the ideal case is the year before you retire, you do a big loss sale, and then you're at a lower tax rate the next year. But the reality is that someone who's about to retire probably doesn't have unrealized losses in their portfolio. So it's like you have to have this perfect storm of a situation to make the loss sale obviously beneficial enough to offset the tracking error of an ETF that you didn't originally want to own. The tracking error could be positive too, though, I guess, but that's a random risk.
Right. Fascinating. I would venture to guess that most people who have prior gains would love to bank the loss to get the refund.
Probably. And we've done that too. And even though I'm not generally, like as you can tell from this conversation, I don't think tax loss selling is like an obvious tax alpha. I think it can work in some cases, but we are super selective with when we do it. Someone has to be in a high tax bracket. They have to have a current or past year capital gain or an obvious maybe future capital gain. But yeah, we're very careful. Now it's, again, a little different with us because we're using the dimensional stuff, which is a little bit harder to find tax loss selling pairs for. Maybe it's interesting to talk about briefly because we use the all-in-one portfolios, which we can sell and then rebuy underlying components to get very similar exposure. It's just more of a hassle and less efficient to manage. But somebody using Vigro or whatever could do a similar thing.
So on to our bad advice of the week.
This is a hot one.
This is a hot one, and man, all over this woman on Twitter. So
had you heard of her before?
I had not heard of her, but man, I knew as soon as I saw the title of the article, I said, oh man, she is going to get killed in the group on Twitter, just the people we all kind of follow in this community. So the title in Toronto Star was Why Low Fee Investment Products Are Bad for You. And all you have to do is read that title. It's like, oh boy, here we go. You can cue the screams.
I feel a bit guilty about calling people out by name on the podcast, but the woman who wrote the article was Leslie Ann Scorgi. I mean, her name's on the article, so anybody could Google her anyway. But on her website, personally, I found her positioning of herself to be a little bit of a turnoff. just because of the way that she refers to herself as a personal finance guru. I joked with somebody on Twitter that I wonder when guru is going to become a regulated title.
And I mean, it seems her breakthrough was when she was on the Oprah Winfrey show. I think she was 17 or 18 years old. So the video's on YouTube.
And she's written a few books. Like, to be fair, she's strung together what looks like an impressive career. But anyway.
And runs a coaching program where she charges a monthly fee to give advice to people.
I have to say is terrifying based on what she wrote in the article. That people are, I mean, again, it's not meant to be a personal attack, but charging people for investment advice, well, financial advice, I guess, because I don't think she's licensed. But based on the information that she wrote in this article, it doesn't seem like she has a handle on the type of evidence that we talk about on this podcast.
Well, and it's the line that, I think the line that really got me and perhaps both of us is that, this is the quote from the article, that she doubles over with laughter when she watches ads for low-fee investment products.
That's right. Maybe this is why I didn't feel as bad calling her out by name, because it was a pretty obnoxious article.
But when the flash and sizzle of these snappy ads fades, fees aren't the only thing you need to care about. Your rate of return is actually the more important factor and needs to be appropriately paired to your risk tolerance. Absolutely. In plain speak, your invested dollars need to be exposed to a healthy level of market risk in order to grow, and you'll pay some fees for this.
I took some pretty serious issue with that comment because you do want to be exposed to market risk, but no, you don't need to pay high mutual fund fees to get exposure to the market. Let's carry on with the bad advice.
Yeah, so bottom line, though, is that if your investments don't generate a healthy rate of return in the long run, somewhere north of 7% after fees, they won't keep up with the market, and then saving money on your fees won't matter either way. Far too often...
Can we pause there? Did that make any sense? If you're not earning 7% after fees, you won't keep up with the market.
Shows the data that paying more in fees will help you keep up with the market. Like
7% is an arbitrary number. If you own a market cap ETF, you will, by definition, keep up with the market, even if you're not getting 7%.
So let's finish off here.
Carry on.
Far too often, returns get overlooked by investors as they get sucked into the low-fee story narrative. Don't let this be you.
So now, this one I always find to be a bit tricky because we use dimensional funds at 40 basis points versus, iShares at 10 basis points. But Leslie Ann in the article is not talking about higher expected returns from small cap and value exposure. She's talking about higher past returns.
Like the first or the third story we had in this podcast talking about the average MER well north of 2%, which is where the industry is.
So you've got to go find funds with good 10-year performance. And I think in the article, she says that she prefers to use Morningstar to do this analysis.
Ouch.
So if you go find the good funds, so she says, but with research and some investment guidance, you can steer clear of poorly performing investments and focus instead on buying the ones that are generating a strong rate of return. Not expected to generate, the ones that have been generating. Leslie Ann goes on to explain in the article that benchmarks to look for are above average rate of return for the majority of the past 10 years. Independent research from I already talked about the Morningstar thing. Now,
Morningstar said that fees are the one thing that is a predictor of higher returns.
So Morningstar's always said this. They've formally done 2 papers on it, once in 2010, once in 2016, where they looked at their whole database of funds, and in both cases found that the single best predictor of future fund performance was fees, where lower cost funds almost always had higher returns than higher cost funds. They broke it up into quintiles. The cheapest quintile always beat the most expensive quintile of funds.
There's a ton of data to back this up. I mean, we go through all kinds of data points, but I think everyone knows our main message.
Yeah. So Leslie Ann, there was some dialogue on Twitter about this. And this morning, actually, we're recording this on Friday.
The 30th.
So this morning, or maybe it was last night, she posted on Twitter that she apologizes. The title of the article was misleading, but she's asked the Toronto Star to change it. So actually the title we said, Why Low Fee Investment Products Are Bad for You, it's changed now to something slightly different.
It's changed to low fees are important, but don't overlook rate of return.
So my response on Twitter was that changing the title wasn't enough.
Change what was said.
So she finished the story with, fees should be a side note, not the main storyline. And again, that's at complete odds with the arithmetic of active management from Sharpe. It's at odds with Morningstar's data.
And it's at odds with what was actually said in the article.
What do you mean?
She doubles over in laughter when she watches ads for low-fee investment products. Anyways, fees matter.
Fees are arguably the most important predictor of future fund returns. Now, Mark Carhart, in his 1997 paper on persistence in mutual fund performance, did find that funds that were persistently outperforming, mutual funds that were persistently outperforming, were doing so based on exposure to the known factors. So I think that as important as fees are, acknowledging my own biases here, as important as fees are, exposure to the known risk factors are also pretty important.
Got it. Anything else?
No, I think that's it.
Great. Thanks for listening.